When we go out and buy multi-million-dollar properties like these all over the country, most of the time we're going to get a loan to buy them. So where do we get these loans from? Number one, we're going to go out to a traditional bank and ask them to approve a loan to buy a property like these. This worked great for local banks in the area, local banks in the market, so they know the property. Someone from their commercial lending department can go out to the property and see the asset itself that they're looking to lend on. These banks are going to give loans for all kinds of things, from cars to your own personal residence to multifamily properties. Banks can give competitive interest rates, they can structure repayment terms that work best for your business plan, and they have a pretty well-established lending process. To get a loan from a bank like this, you better have a good credit score and a good financial history. They offer commercial mortgages and also lines of credit, depending on what you need for your business. Number two is a private money lender. Private money is going to have more flexible terms than a traditional bank, and they can have a much faster approval process, which can help you when you're making offers to potential sellers. It's always attractive when you can close quickly. With a private money lender, you can customize your terms and you can let them know what you need if you're going to get this property closed. Private money could actually be an individual person, it could be a group of investors, or there are firms that put together funds to go out and loan on properties like these. So your best bet if you're looking into private money is to start developing those relationships now and vet them and let them know who you are. So when it comes time to present them with a property you need a loan on quickly, they already have that relationship with you built in advance. Number three is hard money lenders. Hard money lenders are actually different from private money lenders. Hard money focuses mostly on the collateral value, not so much you as a lender. They're typically higher interest rates and shorter term loans. Hard money is especially great when you have either a lot of construction to do on the property, if it has really low occupancy, or if you just need money really quickly. Also, if a local bank won't give you a loan and you can go to a hard money lender, there's a good chance if your property is worth its salt, they'll give you a loan. If you're looking into hard money lenders, I really advise you to do your due diligence on them ahead of time. Get to know who they are, what their terms are, and what you're in for before you take on that loan, because hard money is expensive. Number four, you can get a loan from a crowdfunding platform. The way crowdfunding platforms work is they'll typically have a website or something that you can go on as an investor. You can put your money in and they will pool it and then go and loan it to operators who need the money. This gives investors fractional investment opportunities if they want to invest in property, but maybe with just a little bit of money. And for you as an operator, that might not be that useful. But when there's a whole group of them and they've all decided they want to invest in the asset class that you're providing, like an apartment complex, you can link up on this crowdfunding platform. Now, as an investor, it's really important to get to know these platforms, get to know their fees, their history, their credibility, and how long they've been around, and if they plan to continue being around. And number five is seller financing. Actually, we're seeing a lot of that this year. While interest rates are super high, if you want to strike a deal, seller financing can be a win-win. Now, this is where the seller actually acts as the bank for this transaction. You're going to give the seller a down payment, and you're going to negotiate terms of your loan with the seller. Then you're going to make your payments to them, and you're going to buy their property over time, just like you would with a bank. You can get really flexible terms, you can get really flexible payment schedule, and you can avoid a lot of the fees involved with a traditional lender. Now, to address some of the risks here, you really need to have clear documentation, really have everything spelled out in writing, and get approved by an attorney. Now, seller financing can begin as simply as having a conversation with the seller or letting your broker know, hey, I'm looking for seller finance deals. When you speak with the seller, make sure you make that a part of the conversation and you can start from there. For multifamily, we utilize all of these strategies in one form or another, depending on the business plan. To learn more about multifamily investing, you can go to amitycashflow.com. My name is Chris Collins. We'll talk to you more tomorrow about investing in apartments.